cash has option value for us. And because it does, we can wait for opportunities. If the market is tight, like it is now, we probably are saying no to more transactions. We're going to hold out for different kinds of strategies. We have long been very skeptical about consumer-related credits. That whole concept of that cash having option value, because we view reinvestment not as a risk, but an opportunity. The nice thing about credit, particularly cash flowing credit, is that you constantly have a chance to refresh the going rate of capital. And so when spreads widen out, you can lean heavier in, particularly those that might be in the more liquid areas. Private markets do best in sort of a more steady state, whereas the augmentation of liquid assets can help you with the opportunities as they arise. Interest rates have risen, meaningfully from zero. And so that has been a very nice tailwind for our portfolio.
Welcome to The Institutional Edge, a weekly podcast in partnership with Pensions and Investments. I'm your host, Angelo Calvello. In each 30-minute episode, I interview asset owners, the investment professionals deploying capital, who share insights on carefully curated topics. Occasionally, we feature brilliant minds from outside of our industry driving the conversation forward. No fluff, no vendor pitches, no disguised marketing. Our goal is to challenge conventional thinking, elevate the conversation, and help you make smarter investment decisions, but always with a little edginess along the way. Welcome to another episode in our Private Markets series. I'm Angelo Calvello, the host of the series, and my guest today is none other than Don Pierce, CIO at San Bernardino County Employee Retirement Association, a position Don has held since 2010. He's responsible for the day-to-day operations of the investment division, including developing policy and investment goals, implementing investment objectives, and selecting investment managers. During his tenure at SBCERA, Don spearheaded a rebalancing program for the fund, which generated over $1 billion in gains for the system since its inception in 2006. And I guess we're going to give a shout out to our friend Arun Moraliter. Don, you hold a bachelor's in science and statistics from San Diego State, and you're a CFA charter holder. You can find Don's entire bio in the notes. Hey, I want to warm you up a little bit. I'm going to give you a quick fire round here. Would you rather invest in passion or numbers?
Numbers.
What would be your alternative career path?
Wow. Anybody ask me?
Too tough of a question, Don?
Yeah, I've been long in the tooth on this, and one of the reasons I say that is because when I left San Diego State and started my career, I was doing actuarial work, and I left the actuarial program to go into investments. So this is the alternative career path.
Okay. And my final one is, what's your favorite opening chess move?
Oh, E4.
There you go, man. See, I told you these would be easy. I shouldn't have thrown you the curveball, though, but okay. So, hey, let's go to our topic here, and we're talking about private markets. Could you give me a quick review of your exposure to private markets and, kind of how you're allocating capital across the various opportunities in this space?
Sure. I would say that approximately 50% of the portfolios in private markets between private equity at about, 18-ish. And then we've got, about 3% in real estate. And then the residual, and then another 5% in commodities. And this would be the actual commodities businesses, things like cattle and grain silos and things like that. And then the residual would be in private credit. And for us, private credit includes some of the structured credit.
Okay. And when you're talking about commodities, it sounds to me like it's real assets. Is that a fair way to describe it?
Absolutely. So we own, we are owners or part owners of one of the largest U.S. cattle feeder business in the United States.
Wow, that's a real asset, man.
Yeah, it is a real asset. So there's about 800,000 head between a number of feedlots that we own and operate.
Wow, cool. We can talk more about those in a minute. I want to go back to private credit. And I think you said, and if my research is right, it's about 25% to credit. Is
That's
that
about right.
roughly where you're at? Yeah.
Mhm.
And
Which
that may
is
be
U.S.
the one of
and international. Yep.
right. And that international exposure, if again, my research, which is always dangerous, it seems to me that you've been moving more and more into like specialized and kind of diversified opportunities globally. Is my close?
You are spot on. So we recently hired four European credit managers that will augment our existing platform. That I would say had focused a lot on structured credit, which has been terrific for us. But we're widening the aperture to include a number of other strategies that we're excited about, but are still between, getting inked and finalized.
I'm not that interested in the specific opportunities. I'm more interested in the process. I mean, how did you come to the decision, I guess, to expand and diversify your private credit exposure?
So, and that's a great question because, it is certainly the case that if outside looking in, uh, you wouldn't say that we were particularly underweight in credit. I mean, we have always had a pretty heavy credit allocation, but that's mostly driven by our investment philosophy, which tends to be very income focused. We also tend to view ourselves as very opportunistic, and so the opportunity in Europe um, was, I would say, came to us from just looking at our existing pool of managers in Europe and understanding that we had a lot of structured credit exposure, which is, again, had been a very terrific provider of capital and returns for us, but that we had gathered and assumed that there were other opportunities. And so when we started the initiative, our European credit survey, um, not unlike some of our other searches that you get I think you get surprised sometimes from the richness of the opportunities. And so when the managers were putting forth their proposals, I would say that we ended up hiring four, which is a really high hit rate in terms of just normally, we might hire one or two, but the team found four firms that we felt had the breadth and a lot of differentiation between the strategies that they do. So in that regard, it was one of our richer finds in terms of opportunity, and so on that. So that's how that came to be from a process standpoint. But because we tackle these on a bespoke basis. So we have a way to try and access the marketplace. We are very asset focused. So, in other words, I would rather own assets than funds. And so, that necessitates and lends itself to a more bespoke and negotiated discussion around the account and what we're trying to accomplish.
Just digging a little deeper in terms of the diversification globally. Could you tell me, is it Europe, Asia? Is it just big building blocks, or did you get more granular than that?
So I would say that on the geographic side, it's mostly the U.S. and Europe.
Okay.
We have not found Asia to be particularly rich in the kind of income focused strategies that we're focused on. They have a lot of other strategies that, from a credit standpoint, are more, I would say, more pick or growth, participating in like a structured equity structure or something like that. So, but it's not exactly the higher income focus that we have, and so we've really um, stayed within Europe and the U.S. So, within that context, we had for a long time eschewed uh, the direct lending, but one of the managers that we hired has a very big platform as a direct lender, and with base rates higher than they have been, we found that to be more attractive in terms of coming in. We're looking at somebody that's I would say a much more nimble, smaller trader, and then we've got a sort of asset-backed lender type, and then we've got somebody that is, I would say, the euphemism of the day is solution capital. So we're effectively a hard money lender.
And you've used the term "we" quite a bit. Is there? I mean, you want to step back and tell us your governance structure?
Sure. So I have a board that we report to. I have a terrific CEO, and from there it comes down to me, and then I have a terrific team of folks that help us execute on the strategies that we're trying to implement. Um, and we're in the marketplace for hiring some new folks. So they're still that's still in process, but hopefully I look forward to folks joining us in the near future, and helping us with what is admittedly a higher touch mandate approach. Because we are asset focused. It requires a lot more engagement with the manager to discuss the particular assets that we're going to look at.
So, given you're asset focused more so than fund focused, does this take us into the discussion of the master custody account and how you access these opportunities, at least a few of them?
Yes. So the master custody account structure is a contract structure that allows us to, in effect, access the manager's entire platform, or as much as they're willing to let us. And on that front, uh, the most ideal manager relationship is the one that allows us to access all assets that they consider and bring it to us, and under the auspices that they know what um, our priorities are, mostly cash and income. And in that regard, the way that we structure these is through the MCA structures, the contracting that we do, and it has a lot of bells and whistles associated with it. And we've made refinements over time. I would say that, if you looked at an MCA 10 years ago versus one today, the one today has a lot of learning in what has worked and what hasn't. And so a lot of times the managers are creating funds of one underneath the MCA pool. And so that helps with some of the administration as well.
I mean, that MCA thing, I know of one other asset owner that does this. It's our mutual friend, Tim Barrett.
Yes.
And I'm sure there's a few others.
My former boss and mentor.
And just a great mentor and a friend of mine too. I hope to get him on the show. We've been going back and forth talking about whiskey barrels to see what we're going to do. But
He's quite that's something that he had shared with me on. I was hoping more for the actual contents, but no, he had so it's really terrific and interesting.
I'm going to go back to this. You made this, I'll call it an increased allocation in global. What's the pacing like internally? I mean, it's not like you just like one day you just say, okay, I'm going to hire 4 managers. Here you go. I mean, there's got to be some kind of pacing to this.
Yeah, so I would say that the pacing probably took longer than we would have expected, and some of that's just it is not a linear function. Like if you bring one manager on and then bring another one on, it's not twice as much work, because then they start interfering. And so bringing 4 managers on pretty much near the same time, I would say, has proven to be more than 4 times the work of one, as a practical matter. And then, but the process itself, not unlike other search processes people go through, you get the initial proposals, you read through them, and the ones that attract you, you end up going out and to visit. And in this case, I had the joy of sending my team out along with our consultant to London in January. That was just delightful, and it's a kind of growth opportunity I welcome. And so so when they're there, they review the various folks, and not unlike other folks, we come back and discuss the ones that we want. But from a pacing standpoint, onboarding, once the documents are inked, we tend to be very bottoms up in our approach. And so because we have that asset by asset focus, what we really want is, as the assets start to come in and request for capital, it tends to be okay, let's look at the transactions that would fill it, as opposed to you're buying already a set pool of assets, which you would see much more likely in a public market space where you're actually buying a listed portfolio. Here, you're building it up piece by piece, and so that facilitates a bottoms up asset by asset approach. And that, I think, has allowed us to dollar cost average in, and we can also see who's got a different pacing. You might have one group that's relatively moribund and the other one is really going to town, and then it sort of ebbs and flows. So it's a nice way to also get information from the marketplace on where activity is occurring.
Let me step back and I see what you're doing in credit. There seems to be a discussion in the industry about credit, and there's talk about rate cuts, there's talk about credit spreads tightening, and there was a few, how would I say, credit deals in the news lately that got people's attention. I mean, do you have any thoughts, about private credit in general, and your expected returns in the future?
Yeah, so I having lived through private credit during the time period of zero interest rates, it's much more comfortable to be at a four handle. And
Mm-hmm.
I mean, even if it went down to 3.5 or 3.25, that's still very accretive to the plan. And if I had to put a point on it, I would say that direct lending in general, and when I say direct lending, I'm this is probably more in the middle market area, but you should probably get between 9 and 11%. And when interest rates are really, really low, it's going to be in spread. And when interest rates are higher, it's going to be on the rate. And what you hope is that if spreads tighten too much, you eventually get exited out, and you can decide to whether you want to reload. And then if interest rates come down, you have choices. And one of the things that, I mean, it is a catechism of mine that we like, to be fully invested is not a virtue. Like, cash has option value for us, and because it does, we can wait for opportunities, and that's part of our opportunistic approach, which is that if the market is tight, and like it is now, we probably are saying no to more transactions, and also we're going to hold out for different kinds of strategies. I would say overall, the things that you see in the news so far have all been kind of consumer related. And for a long time, we have long been mostly very skeptical about consumer related credits.
Mm-hmm.
And not to say that people can't make a lot of money, but it also is the thing that is the sand that can disappear the fastest, as we see it.
Can we go back to your comment about how cash has an option value?
Yeah.
And Does this play across the entire portfolio?
Oh yes, yeah. That's that whole concept of is that cash having option value, because we view reinvestment not as a risk but an opportunity. And the nice thing about credit, particularly cash flowing credit, is that you constantly have a chance to refresh the going rate of capital. And so when spreads widen out, you can lean heavier in, particularly those that might be in the more liquid areas. And then as that ebbs away, but the environment still is attractive, I think that's where you see a pickup in private markets. So I would say that private markets do best in sort of a more steady state, whereas the augmentation of liquid assets can help you with the opportunities as they arise. Particularly in the short-term basis. Long-term basis, we've lived in a marketplace where interest rates have risen, meaningfully from zero, and so as a practical matter, that has been a very nice tailwind for our portfolio.
You mentioned opportunistic, and you talk about how cash, has an option value. It kind of leads me into, rightly or wrongly, my podcast, into the topic of co-investments and secondaries. It would seem that those types of opportunities would fit well with both the opportunistic approach and cash with the option value. Am I right?
Yeah, so we definitely do a lot
Okay.
of co-investment, and
Mhm.
but that also can tell you something about the marketplace. If you see if if you're being pitched the fifth consolidation of a car wash business, that's probably the what's the famous phrase, what the wise do in the beginning, the fools do in the end. I mean, by the time you've seen the fifth or sixth iteration of it, you're probably already a little jaundiced about it, and are say, good luck with that. We're going to pass, but so I think the nice thing about the deal by deal co-investment approach is that it also tells you a lot about the investment underwriting discipline, because you could have discussions with folks that maybe 2 years ago they would say, well, we would never do this, and then suddenly you see a deal that has that very thing that they would never have done 2 years ago, but that's the market. And so I think the firms that do the best with us tend to be those that have a more absolutist view on what is good and not good, as opposed to this is what the market's doing right now, and so by definition it's reasonable and fair. We do not share that view. So on the secondary side, we have not seen that play out as much. I mean, you're buying a secondary pool of assets. A lot of times there's a little bit of ongoing commitments that you have to make. So they're not as seasoned as they all would like. And so you're buying some unfunded. And that may be a feature and not a bug. But that kind of asset, while it has its charms, we definitely have not seen the kind of distress selling that would make that to be something that we would lean into a lot.
You mentioned private equity just briefly. And if I recall, you said you have about 19-ish% in what we would call private equity. And again, doing my research, which is always dangerous, it looks like you commit about $600 million annually. Fair? Is that close? Or
Yeah, so there's the budget. There's the budget amount, and then there's the what we probably do, and that has ranged between I would say 575 and 650. But yeah, the 600 million spot.
Okay,
All right.
And I mean, this takes me into the topic that I mentioned to you, and that is your emerging manager, or I think you call it your headwaters fund. Is that 600-ish part of the allocation that goes into this emerging manager program?
Well, so it is budgeted for, yes. So the short answer is it's part of the budget, but we sequence it out, on a yearly basis, and so to the extent that that program is um, approved, and but is still like we're at the ready to go, but it's I think just needs to get finalized on some internal dialogue stuff.
Okay.
But the plan is that we would that program, which focuses on funds 1 through 3 in their life cycle, with the hope being for us is that those folks would then, the ones that we've followed, we would then be able to, the ones that we think are worth doing, and we have capacity, we can, follow them into funds 4, 5, and 6.
Is the thesis here that these emerging funds, these newer funds, have more upside,
Yes.
more
Yeah,
opportunity for return?
not put too fine a point on it, but yes,
Okay.
that you get more bang for your buck on those early vintages, assuming they work. If they don't work, then then you've got a different problem. But I think because the you have what we think is an opportunity that has some other softer benefits, such as you're early with this manager that's on a successful growth path, and if you end up hiring 12 or 14 of these folks, but and 3 or 4 work out that they're long-term winners. I mean, that's the kind of thing that we want to participate in. And
Yeah.
we think that the give up of picking some mediocre ones, and we think that we have an excellent partner with Adam Street to help us with that. And so we hope that the dogs that we have that invariably happen are not nearly as bad as they could be, and you hope that the ones that you can grow with are exceptional.
Well, I look forward to see how that program plays out for you. Is that another MCA structure you're using
It is
with Adam
part of
Street?
an MCA that we have with Adam Street, yes.
Okay.
But not unlike some of the other iterations where it creates its own SPV for it, and so there's some structuring involved that helps keep it all together.
Let me broaden the discussion a bit. And one of the reasons I wanted to talk to you, Don, is not just about private credit, but you've always been a forward-thinking asset owner. I'm not going to call you a gunslinger like some have. That's not my place to do that. But you've been a forward-thinking guy. And one of the things that struck me, because I'm always interested in governance, is you guys hold an annual strategic planning retreat.
Right.
I mean, it sounds like a great idea. Maybe tell me about it.
Sure. So we host this every year at beautiful Lake Arrowhead in September. So it's very clement, and so you get a chance to go up the mountain. Admittedly, for the first, for people who go up the first time, going up those mountain roads can be a little treacherous, and so I always feel a little bad about the winding roads going up this.
It sounds like a metaphor for governance in general.
That's right. That's right. So there we get together, and generally speaking, we kick off the day with a keynote speaker, and then our consultant and I usually lay out the plan for what's the goals of the plan, and reiterate our philosophy. Income, value, and opportunistic, and we then do some highlights on the program, what we call investment spotlights, and usually it involves something like what we're talking about today, which is how opportunities converge with the implementation, and how does that service the goals that we're trying to accomplish. And that's the nice thing is that we do that with all of the managers coming in to visit us, and it's not only a good chance for them to meet each other, but for them to all hear directly from us, here's the things that are important to us. And our trustees get a chance to talk with the managers. And so as an overall networking um, chance, I think, because the board is very, very busy and they have a lot of different things. I mean, I know that the investment community thinks that like we do investments all day, but actually the pension system, most of the work is actually like handling the members and dealing with disabilities and other requests. And so we're um, a part of the organization, but the organization itself, the trustees have to manage in total. And it is a chance for them to have a networking opportunity to talk about whatever it is that they would like to talk about. And so we think next year will be our 25th anniversary of doing it in this form. So yeah.
Wow.
Yes.
It must be a bit of a challenge to pull it all together logistically, because you've got your trustees, you got staff, and yeah.
Yeah, so I have a terrific staff that helps with this, and um, it's grown. We had over our maximum. The largest number I think we had is 108 folks come out, and so I think we're at the point where we're going to have to institute waiting lists and things like that, and that'll be yet another.
Wow.
To your point, that'll be yet another administrative thing to keep track of. On if this person falls out, can you contact them and add them in? And so, but I have a terrific team that handles that.
Well, I mean, this event must be creating value, or you wouldn't have done it for so many years and deal with just the back of the house logistics stuff.
Yeah, and there are times when I would say, particularly when maybe you're not feeling as great about the portfolio and you've got a bit of a black eye and you're not looking as clever, and you get to do this exercise because not everything is sunshine and roses in this business, and sometimes you look kind of not very clever, and the strategies that you picked aren't working, and everybody else's strategies work much better than yours, and why aren't you doing that, and so on. And what I found, particularly when we had to put it on a hiatus during the COVID shutdowns, was I think you really understand that softer networking advantage that you have, because suddenly everybody felt a bit stale about the connection to the portfolio. And so I think that it's while at times you can, when you're in January trying to rack your brain for what are we going to talk about, it's probably not unlike you. You have to come up with new things to talk about every podcast, and so it can be a little daunting. And we only have to do that once a year, but it's we try to after having done it for a long time, you want to give it the same energy as you did at the earlier stage of life. So
yeah, that's cool. I mean, I'm impressed you're able to pull it off without like this big event staff. That's what I have in the back of my mind. If you have this many people and you're dealing with trustees, staff, and managers, people can be a little prickly sometimes.
So I would say that certainly technology has helped. I think we use Cvent. So there has been it was definitely a much more manual process earlier on. That being said, what you picked up in logistic synergies on that side of it, you get, other joys. So I think it is a massive undertaking that our team, my crew does, and it's a lot of work for them.
And it's worth the effort, is what you're telling me. At the end of the day, it's worth the effort. Tell them. Yeah. I hope your trustees feel that way too. I mean,
I know.
I got three questions for you to wrap this up, Dan. The first one has nothing to do with what we talked about. It's just, kind of your general view. There's a lot of talk about alternatives and private markets and 401k plans. Good or bad? What do you
Bad.
think?
Bad.
Okay. You don't have to say any more. That's fine. Second, I know that you guys are using AI in your call center to improve member experience. Are you doing anything on the investment team with AI to improve workflow or maybe even improve investment decision making?
So more on the back office document um, integration side. So in other words, we have a document integrity program,
Mm-hmm.
and we get a lot of data and documents coming in, and I think AI is going to be a big, and we have a document management system that we're trying to implement. And it already has some major differences. I think most of us are all familiar with the file system hunt and look for filing, naming conventions and things like that. Um, the machine does it all. So the machine's going to um, uh, name it for you and do all of that. But the way you even access documents is not the hunt. It'll be asking questions, and so
Mm-hmm.
it'll be a much more of an interrogatory process. So I think it will involve a little bit of for those of us that grew up with these graphic user interface things that we on file systems. Here you're going to just ask it questions, and
Yeah,
so we're excited about that. And no, that was
that's
a really
cool.
quick answer.
No, it's okay. Is that in beta right now? Let's say, or
I
have you
would say
rolled it out?
it's in beta implementation. We're still in. We've got 70% of our documents uploaded, and we've got another 30% to go. Um,
Cool.
so we work with a firm to break the MFA nightmare that every manager's got a portal with multiple um, uh, authorization methods, and so we use a service that can deal with that, and then that
Mm-hmm.
automates the collection of a lot of documents, and then there's the manager notes and things like that. And what we're hoping to do is be able to have our system um, pull information out of the system, and maybe with references to documents. So hopefully it should probably feel a little bit like how you interact with Copilot or something.
Yeah, I mean, it's very iterative, is the way you're explaining it. Once you get it up and going, you ask a question, it comes back, and then you go deeper, you go sideways.
Right.
I mean, you and your peers are kind of looking at ways to integrate this to improve workflow at the end of the day, the efficiency in the workflow.
Yeah, I mean, I have a distinct view on the value of machines trying to tell the future, which it's not a great way to spend your effort. So for us, it's funny. We have you could go back to the Oracle of Delphi. I mean, we've always looked for ways to try and tell the future, and I don't know if certainly statistics can't do it, and I think a lot of this is gussied up statistics. So it's definitely not fit for purpose on that front. It's my personal.
So to all you AI managers looking to pitch Don, forget about it. He's
Yeah.
not buying it.
Yeah, no,
He doesn't want an autonomous machine making all his decisions. So
it'll just make the bad ones faster. No, I'm just kidding.
all right, so let's wrap it up. Final question. Worst pitch you ever heard? And if I remember, Don, you've been doing this since like 2006 or something when you moved over from the dark actuarial side. Is that right, roughly?
So I would say, so I actually started in 2001, and one of my worst pitch, the marketer called, and they were trying to pitch active, large cap equity management. And I was telling them at the time, I said, we've not experienced a lot of good experience in that space, and so we've moved to passive. And the person trying to says, so you're not interested in 14% returns? I'm like, yeah, you're right. I'm just not interested in that. Thank you. I was.
Yep.
Yeah. So That was probably the worst pitch. I would say in
forecasting
general,
the future.
yeah, yeah, I think leading with your numbers, I don't know if it works for anybody, but certainly not on me.
Nope. Well, this has been great. I appreciate you taking the time and sharing, your experience in private markets, private credit, what you're doing on the governance side, how you're working with emerging managers, accessing these through the master custodial arrangement or account, I should say. It's cool stuff. And I really appreciate you reconnecting and taking the time.
Yeah, no, thank you for inviting me. I really appreciate the chance to talk it over with you.
Thanks for listening. Be sure to visit P&I's website for outstanding content and to hear previous episodes of the show. You can also find us on P&I's YouTube channel. Links are in the show notes. If you have any questions or comments on the episode or have suggestions for future topics and guests, we'd love to hear from you. My contact information is also in the show notes. And if you haven't already done so, we'd really appreciate an honest review on iTunes. These reviews help us make sure we're delivering the content you need to be successful. To hear more insightful interviews with allocators, be sure to subscribe to the show on the podcast app of your choice. Finally, a special thanks to the Northrop family for providing us with music from the Super Trio. We'll see you next time. Namaste.
The information presented in this podcast is for educational and informational purposes only. The host, guests, and their affiliated organizations are not providing investment, legal, tax, or financial advice. All opinions expressed by the host and guests are solely their own and should not be construed as investment recommendations or advice. Investment strategies discussed may not be suitable for all investors, as individual circumstances vary.